1-2, how the business activities change the accounting equation. In 1-1, we learned the accounting equation, where assets equals liabilities plus owner's equity. We call these three headings classifications. Within each classification, there are accounts. The first account we're going to look at will be cash. Cash is an asset. It has value. In addition to cash, we will also have supplies, where we buy items we use in the business, and we will have what we call prepaid insurance. Our liabilities will only have one right now, and it's called accounts payable. And we have one owner's equity account, which we will call capital. The accounting equation must always stay in balance. So the first transaction was receive cash from owner as an investment. And let's assume the owner put in $5,000. So we have an increase of $5,000 in cash, and we have an increase of $5,000 in capital. So our balance now is $5,000 in assets, $5,000 in owner's equity. So we're still in balance. Assets equals liabilities plus owner's equity. Our second transaction is we pay cash for supplies. Supplies are something we need to run our business. So our supplies went up by $500. However, our cash went down by $500 because we paid cash for it. So our balance now is $4,500 in cash plus $500 in supplies, which equals $5,000. We did not affect the right side, so we still have $5,000. So assets equals liabilities plus owner's equity. Our third transaction is we paid cash for insurance. So let's assume that we paid $1,000 for our insurance. So if we paid $1,000, we would subtract $1,000 from cash, but we added $1,000 to insurance. That transaction balances. It wipes each other out, a minus $1,000 and a plus $1,000. So where are our balances now? We now have $3,500 in cash, plus $500 in supplies, plus $1,000 in insurance. That adds up to $5,000, and it still equals the $5,000 that the owner originally put in to the business. The final transaction, well, actually there's two more. We bought supplies on account. On account means on account of we didn't have money at the time. So what we got was $750 in supplies. However, we bought it on account of we did not have the money. That's what accounts payable is for. So now our balances remain at $3,500. We're up to $1,250 in supplies, $1,000 in prepaid insurance equals $750 plus $5,000. You'll notice we are still in balance. $5,750 in assets equals $5,750 in accounts payable and capital, or liabilities and owner's equity. Then our final transaction is we paid cash on account. So let's say we're going to pay off this balance that we had in supplies. So we would subtract $750 from cash, and we'll eliminate the $750 that we owed on account. So all said and done, we added up, and where are we? We have $2,750 in cash, $1,250 in supplies, plus $1,000 in prepaid insurance. We paid off that, so we have zero in accounts payable plus $5,000. And when we add this up, we have $5,000 of assets equals $5,000 of liabilities and owner's equity. Therefore, the accounting equation in this balance and our transactions work out well for us. And that concludes section 1-2.